right, so it's 4:02. We'll kick things off here. For those of you who I haven't had a chance to meet yet, my name is Christopher Kerlow, one of the newest members of the Langsford Wealth Council. Matt and I have worked together for a while at our predecessor firm, and I joined the team in February to help support as a senior investment officer, advisor, as well as supporting Matt extensively on the investment management capacity, where I've spent the majority of my career in both an institutional realm as well as working for a private family office and helping retail investors achieve their retirement goals. So the purpose of today's presentation is to give an outlook of where we are in the market cycle and where we see things going. This is to try to help disseminate our information. I plan on doing these on a monthly basis, probably around the first Wednesday of every month. This will give us a chance to explain recent portfolio changes, as well as opportunities we see in the market and risks we're trying to avoid. From time to time, we'll bring on special guests from some of the partner firms that we work with to help provide investment solutions to you, our clients. There is a chat feature. Mitchell on my team is monitoring that. We'll bring up the questions at the end, and we'll be able to answer any of those. So feel free to write your questions in the chat if you haven't sent them in ahead of the presentation, and feel free to bank them for next month as you see things out there in the markets, so that we can help address those questions for you and the rest of our clients. This will just be 10 minutes, and we'll try to leave some time for questions at the end. So this is our standard disclaimer slide. So obviously the markets had a really tough start to 2022, falling between 25 and 30% for most of the major averages, until we saw a bit of a reprieve rally starting around June 16th up until about a week ago. It's been a tough couple of weeks since Jerome Powell's speech at Jackson Hole. Before today, we saw the NASDAQ down 7 of the last 7 sessions and 6 out of 7 for the TSX and S&P 500. We're closing the day here meaningfully higher in most markets. Oil's a little bit off, but otherwise a bit of a rally here today. There has been a lot of assimilation drawn to both the 08 financial crisis and both 2001 dot-com bubble, where we saw major pullbacks, a bit of a bounce during the summer months as we saw this most recent rally, and then again another major pullback. The difference with this is quite apparent with the fact that we're in a much more stable, particularly labor environment. The unemployment rate in both Canada and the United States is at 50-year lows right now, but that's not to say that we're completely out of the woods just quite yet. We saw this most recent pullback, as I mentioned, following the Jackson Hole speech that Jerome Powell gave. I think leading up to that, the market was fairly optimistic that we were going to get a bit of easing from the Fed after several rounds of rate hikes, which hasn't been the case, and they've committed to kind of keeping their foot on the pedal, similar to the Bank of Canada, where we saw a 75 basis point rate hike take place here today. This chart on the bottom right, for illustrative purposes, shows kind of the two scenarios we see playing out. One would be a kind of longer for sideways type of muddling around here, and then returning to growth in the start of next year. And the other is the fact that we could be at a great buying opportunity, and we'll get into some of the areas of opportunity that we've recognized and are positioning capital into as we move forward in the presentation. So there's certainly a lot of talk out there about the possibility of a recession. In the United States, the first 2 quarters of this year actually had negative GDP growth. Typically that signifies a recession, but the National Economic Council actually did not call it that because of the underlying labor market conditions. Unemployment still 3.6% stateside, not much higher here in Canada, with significant job growth. For the moment, a lot of that strong job growth has offset some of the impacts that the Fed is trying to exhibit with their rate hiking. But one of the more ominous signs that's starting to get a lot of attention is the inversion of the yield curve. What that means is that longer term government bonds are trading at a lower yield than shorter term government bonds. When that's happened 8 of the last 8 times we have entered a recession. This is a forward leading indicator, much like the stock markets are. You can see we've identified those here in the chart on the right side. The duration of those pullbacks varies. We've listed the time as well, and as well as the size of the pullback. That's not to say that we've already had that pullback and are now on the way up, but the chances that this does get called a recession at some point in the future are fairly likely. It has a lot of the undertakings despite that strong labor market environment, and unfortunately for some, that's part of what the Fed is trying to accomplish here, is cooling that tight labor market. One of the risks you run when you move into a recession with a very tight labor market is spiral wage inflation, where consumers are able to afford higher prices, which brings around even further higher prices. However, if we do look at the chart on the bottom left, you can see expectations for rates continue to move up as we go through time. But by 2024, it's expected that they move lower and longer term back to a more normalized rate. That would signify that at some point in the future, the Fed moves from what's called fiscal tightening in what we're experiencing right now to fiscal easing, or monetary easing, pardon me. And so we would expect to see some economic weakness, but the chances that rolls through the stock market may have already been realized, but also some more across the board selling like we saw in the first half of the year gives us the opportunity to take advantage of some of the babies being thrown out with the bathwater in the market that we've seen percolating already. Inflation is where the Federal Reserve and the Bank of Canada and central banks around the world are really stuck between a rock and a hard place. They have a dual mandate of unemployment and maintaining inflation, and inflation has run fairly rampant, not only in North America, but around the globe. Fortunately, we are seeing signs that may be peaking and we may have hit peak inflation. I am trying to show that here with the chart on the top left. This is looking at forward inflation expectations with the blue line 1 year into the future. The black line is looking 3 years in the future, and the gray line 5 years into the future. So if you look at the blue line, you can see that expectations ramped up as we moved throughout last year, but have started to roll over. And longer term expectations are that we do come back to that kind of 2.5% long-term inflation target that's both targeted by the Bank of Canada as well as the Federal Reserve in the United States. There's been several causes for inflation to be running higher. One is that during the pandemic, we obviously saw a lot of relief spending by governments. The US pumped about 1.9 trillion within a year into the economy. That's starting to roll off, which should give us a bit of reprieve from that. There's also a bunch of double order taking right now. Consider a company like Ford Motor Co. that's been ordering semiconductor chips for the last year and only receiving at best half of those orders. They start from naturally trying to game that, ordering double what they'd like to receive half. And at some point that game runs out. Not only that, we've been seeing both hard goods and durable goods increase in inventories at places like Walmart, Target, and others, which at some point that glut will need to be relieved through discounting, which should help reduce some of these inflationary pressures. On the consumer side, credit is becoming harder to obtain. The chart on the bottom right is showing you kind of the chances of delinquency, which is increasing the standards that you would need to borrow at some of the big banks. And then lastly, I'd highlight that immigration all but came to a halt during the pandemic. And we're starting to see that coming back into both our economy as well as the United States, which helps with some of the more labor intensive work that is necessary to make the economy go. And then also productivity, the return to the office should help that. Ultimately, we believe inflation will normalize, and that presents a great opportunity for companies because their inflation adjusted earnings will be higher at the end of the day. And then but there are a couple problems that the Federal Reserve does struggle to control. One is energy prices, which I'll cover on the next slide. And secondly is this war between Russia and Ukraine intensifying into tensions between the East and the West. Monetary and fiscal policy are struggles to control that. We have seen the price of oil and natural gas and the price at the pump hit eye-watering levels here in North America, but that's nothing compared to what we're seeing across the pond in Europe. The price of natural gas in Europe hit a high of about $1,480 a euro, which is equivalent to about 4 times the price of oil here. And unfortunately, overnight, some news came out of Russia that they're shutting off all supply of the Nord Stream pipeline until sanctions are removed. At the same time, the US reiterating their intention of intensifying sanctions by December 5th, should we not see that ease further. That's facing a challenge for a lot of companies in Europe. There is talks now at mandatory kind of rationing of energy supplies, which could negatively impact their industrial complex, which has us shying away from the region. And places like Germany that are very reliant on natural gas for heating are about 85% of their normal reserves at this point, but need to continue to build those reserves into the future as heating season takes place throughout the fall and winter. Exacerbating the problem is Saudi Arabia talking about curtailing their production after it was announced this week that Iran will be ramping back up to full capacity. The United States has been emptying their strategic petroleum reserve in a move to try to combat rising energy prices. And while a recession may lower demand, that could easily be offset by China possibly easing COVID restrictions, increasing their energy demand, as well as a replenishment of the SPR into 2023. This is quite a positive backdrop, though, for companies in the oil and gas sector, as well as renewable energy, and many of our portfolio companies benefit from that. A couple of the names we like would be Canadian Natural Resources and Enbridge. I'm going to probably leave our Canadian and US dollar outlook for next month, unless we have any questions on that in the Q&A section. But with the new market dynamics becomes new opportunities. Over the course of the last several years, reckless allocation of capital has yielded quite strong returns, going into paying for companies' growth pretty much at any price. With the SPAC frenzy, even some of these meme stocks and other high growth tech companies, that was the strategy du jour, but that has faded in the past several months as high volatility has made it challenging for them to access capital. Market consensus, though, overall continues to predict higher earnings. We're showing that here in the chart on the right, as earnings growth over the next several quarters continues to remain positive. And despite an optimistic consensus on earnings, we've pivoted our focus to companies that are generating high degrees of cash flow, in most cases that can support a growing dividend. We believe that that's kind of a great place right now to protect capital and move into markets in a safe and kind of orderly way. As well, this chart on the bottom left is showing both volatility in the stock market as well as bond yields. Bond yields are that blue line. You could see that they've moved higher over the course of this year and have presented some great opportunities for us to once again take a look at fixed income. We like floating rate notes, which benefit from things like the 75 basis point rate hike we saw from the Bank of Canada this morning, as well as ongoing rate hikes from the central bank in the United States and around the world. And that credit spread, we would predict it would likely tighten over time, which gives you, again, a bit of a lift on those fixed income portfolios. We've also taken advantage of this volatility through what we would consider a bit of a barbell strategy, moving some of our passive investments or index linked opportunities to active management. We think this is, again, a stock picker's market, as well as implementing some covered call strategies, which may sound complicated, but are essentially using option writing to increase the portfolio yield at sacrificing a bit of the upside to be able to mitigate some of that downside risk. And so although we are possibly in a recession at this moment, we do think that the economy should be able to withstand a bit of economic weakness here, particularly because of the tightness in the labor market, as well as the fact that savings rates during the pandemic were so high that people were able to kind of insulate their personal balance sheets during that period with excess savings. And then secondly, even if we see weakness in the housing market, a lot of prices on homes are far above the entry point, which gives those consumers a bit of safety. So where are we putting money to work right now? Well, as mentioned a little bit earlier, this chart on the right shows you the price to earnings ratio over the past 2 decades for the S&P TSX. You can see we're well below that 2-decade average and significantly lower than we were at the start of the year. When you look at forward return expectations from times when you enter with low price earnings ratios, they tend to be much better than times when you're paying up for securities. So we think that, looking at some of those Canadian dividend names, particularly in our Langsford Wealth Council Canadian high dividend portfolio, can present some great opportunities. And secondly, we're starting to see some amazing companies in the private market. Year to date, late stage companies in the private market have received about 58% less funding than they have last year. That presents a bit of a buyer's market as companies are in need of capital and are reducing their valuations significantly from just 3 to 6 months ago when we were already diligencing these companies, which prevents some amazing opportunities. We're looking at deals right now in the space explorations economy, as well as disruptive technology and nursing, and a really cool renewable energy trade. And so for any of those, feel free to reach out to a member of our team and we can get into some more detail. And that is the presentation for today. So I will stop it there and ask Mitchell if we have any questions from the audience.
Yeah, Chris, so we've got a couple questions that came in while you were talking. And again, welcome everybody in the room to, if you have any questions, fire them into the question box. Or by all means, raise your hand and we can potentially take you off mute if you'd prefer to ask the question verbally. But one question here. Historically, the Bank of Canada has had difficulty achieving soft landings with recent recessions. Is this concerning?
It's a little bit less concerning now because, I mean, if we look back at, let's just talk about kind of the last 3 recessions, which I'll highlight here. The pandemic obviously was a bit of an anomaly, and we were able to kind of make it through that, coming out the back end in quite a stable manner. The 08 recession, which obviously was on the back of primarily a U.S. housing crisis. Although we saw housing prices falling here in Canada during that pullback, it wasn't quite as exacerbated as we saw stateside. But we really have cleaned up lending standards with the Basel III regulations. And again, because of high home prices over the last several years, even a modest pullback in home prices should mitigate that. And then again, the tech bubble of 2000, 2001 was another exogenous event that took place because of excesses in the market. We don't see those same levels of excess. And then adding to that, which was on my Canadian dollar slide, the Canadian economy is on a great footing with the fact that our exports continue to rise significantly because, as most of you would know, and look at the chart on the top right here, we're a very commodity-based economy, and rising oil prices, potash, lumber have all benefited Canada as an economy. So I think that the central bank should be able to handle a bit of a soft landing here.
Awesome. So next question I've got here in the chat is, it's all well and good to look at the markets from an economic perspective, but what about the political outlook? We have instability with Ukraine and Russia. as well as uncertainty in the future U.S. election process. How do you think this will play out in the near term?
So there's certainly a bunch of posturing taking place with leading up to the U.S. elections. There's also tension between Taiwan and China, and the U.S. being a little bit involved there, as well as Russia and the Ukraine. It's very challenging predicting political moves, and not something we're in the business of doing. However, those risks present opportunity. We see companies, particularly with liquefied natural gas as an example, that are doing quite well. Nuclear power is another one. We're seeing uranium start back up in Japan after being shut off since the Fukushima disaster. And so we move around these areas of the market. Another opportunity would be kind of this changing in foreign exchange, where we're looking for companies that are generating revenues in dollars or loonies, while their costs remain in overseas currencies like the yen or the euro. So we're not in the position of politics. We're in the position of financial markets, and we look for those opportunities that present themselves because of these geopolitical risks. And in a lot of time, it's a kind of a buy the rumor, sell the news. I'll kind of circle back to a situation that happened a few weeks ago, where Nancy Pelosi of the United States traveled to Taiwan. Not coincidentally, in my opinion, the Chinese did a bit of a testing event around Taiwan at that same point, and markets moved higher. If we were waiting for that kind of risk to play out, we would have kind of missed the boat on it. And we are here every day monitoring these situations to be able to react when they present opportunity.
Awesome. So got another one here in the question box. Where is gold and gold mining in the great scheme of things?
Sure. So gold mining is a challenging business, but one that I'm very intrigued by and follow pretty closely. Gold miners have been in a little bit out of favor here. We own Barrick Gold in our LWC Canadian high dividend model. It's been a really interesting time for Barrick as an example. It's been a buyer's market. They're able to go out, find best in class resources around the world, scoop them up in a bit of one of the last arbitrages out there, which is utilizing your expensive stock to buy cheaper stock, and then rolling those earnings into your own. They've been growing the dividend great over the last few years. And in gold mining, kind of like the wisdom of Eric Sprott, where you kind of focus 90% of your focus in the bigger miners and 10% in the smaller guys, and hope that those smaller guys can strike it big and find some gold. But it's been a bit of a challenge for gold, and surprisingly, with the amount of monetary stimulus and money printing that we saw both stateside and around the world, you'd expect gold to do a little bit better. Follow that with the geopolitical backdrop. And when we're in those situations when it kind of all goes right, but the stock or the trade doesn't work out, it kind of leads me to rethink the thesis and kind of back away. For the like with what I just mentioned, a lot of the catalysts for gold seem to be out there. However, I do think longer term that there's still strong fundamentals, and it's a place that we do allocate a little bit of capital to. And if we did see the momentum coming back into that trade, we would be interested in increasing our exposure.
So another question here. So what's like one position that you've added to the portfolio recently that you're excited about?
Well, it's one that we've probably held for a lot of you for a while, but I think it is in one of the best spots that they've been in for a while, and that would be Enbridge. Enbridge is not only has the largest network of oil and gas pipeline around the United States, if not the world. They're also a major player in liquefied natural gas, and are able to, at this point, kind of negotiate some really interesting long-term contracts that just give great clarity to their long-term free cash flow generation. And high oil prices are a boon for their consumers, as they're kind of the toll road for those guys to play along. And with this even with this climate or this energy crisis that we're facing, I think it actually lowers the hurdles for them to do some of their expansion projects that have been challenged in years past. And so that's a name that we really like right now.
So it looks like those are the questions we've got in the box right now. So I'll kind of flip it back to you, and I'll watch and let you know if anything else comes into the box as you're kind of saying your goodbyes.
Okay, great. Yeah, thanks everyone for joining. As mentioned at the onset, this recording will be sent out to all of you, as well as my presentation, so you can kind of flip through and take a closer look at all of the details in there, and feel free to message me with any questions you have. Look forward to working with all of you over the course of the next several quarters and years, and keep an eye out for that chance to for us to move you onto this InvestNet platform. I think it's only going to help us achieve your goals in a more efficient, tax efficient, low cost way. And so we're really excited to be working with all of you, and appreciate your trust. Thank you.